Robert, many thanks indeed for joining us on Bloomberg Quint. My first question to you is, what did you make of Budget 2017? Was it broadly in line with your expectations?
I think the answer to that is yes, and I think the starting point is actually a recognition by the Indian government that the process of demonetisation that we had at the end of last year actually has been disruptive to the economy. So I think that there was that recognition is the most important point, and obviously there was a policy response to that recognition by injecting funds into probably the area of the Indian economy which was the worst affected or was the most disrupted, which was the rural economy. I think two other aspects which are worth focusing on is the injection of capital into the banking system, but also a recognition that non-performing loans in the banking system, and the state banks most notably, have to be addressed. Obviously there is a debate as to whether if sufficient capital has been put into the banking system, and I think one has to recognise that further capital injections and further non-performing loan write-offs are going to have to take place. And then I think the third aspect, obviously quite rightly, is the increasing focus, which is very much a long-term focus on the need for increased investment in the infrastructure sector. So I think, to answer your question, it was, I think, broadly in line with expectations, and that is why I think it's fair to say that the market reaction has been reasonably muted. We haven't seen any particular moves either way in reaction to the budget. But I do think that one thing that will impress investors both domestically and internationally is actually a recognition that the growth number for the last year has had to have been revised downwards, and that we do have this realistic response to the fact that demonetisation, certainly in the short term, and my argument has always been that demonetisation short term was disruptive, sure. Although along with a number of other people, I think longer term, and longer term is probably defined as sort of the next 3 to 4 years, longer term demonetisation is probably a step in the right direction. But clearly the data that one saw at the end of last year are to the downside.
A specific question about the budget deficit at 3.2% of GDP for fiscal 18. Has the government walked the talk? Has it towed the line of fiscal consolidation, you think?
Well, I think there are a number of answers to that question. The first answer is that 3.2% as a headline number, I think is not going to worry investors. And certainly, I think the next point that investors are going to focus on is what is the probability of that 3.2% being achieved. And if growth does rebound in the second half of this year, as I think it will do, and associated with that fiscal revenues recover, then I think the risk of slippage away from that 3.2%, I think that risk is reasonably low. I think what would alarm investors, and this has not happened, would be two things. First of all, if there was a feeling that achieving that fiscal target would prove difficult, and I think investors are going to be looking out for any potential slippage. I don't think I should worry about that at the moment, but it's something certainly that needs monitoring carefully. I think the second aspect is that if investors saw a return to what was worrying a few years ago, which was much higher budget deficits. And I do think investors, both domestically and internationally, want to see that India has a long-term plan of, I certainly wouldn't call it, as we call it in the UK, fiscal austerity. India certainly doesn't need fiscal austerity. If anything, it needs the opposite. But certainly a responsible and disciplined fiscal regime.
Let's get to the key question right now, Robert. What are the implications for the financial markets? Will this budget trigger the markets to rally higher from these levels?
I think the answer is it probably will not act as a catalyst for a significant rally. And let's not forget that we've actually started 2017 on quite a positive note after what was, as we've discussed many times in the past, a rather unsatisfactory investment return environment in 2016. But does this budget, is it going to result in a 5 to 10% rally by the second quarter of this year as we go into the new fiscal year? I think not. Having said that, I think the downside in the Indian market now is much lower. I think the next thing that investors are going to look at is what is going to happen to RBI policy. Are we going to get another interest rate cut? If you look at the inflation data, largely driven by a positive trend in food prices. When I say positive, I mean no real inflation. Obviously, there is scope for the RBI to cut interest rates further. And again, I think that would underpin the Indian equity market. So, my thesis for the next 3, probably 6 months is, number one, any slippage in the Indian rupee is going to be very minor. I would identify the downside as 68 to 68 and a half. At the moment we're trading very close to that, so I think the downside risk is very low. Secondly, I think the downside risk in the Sensex is low. I think the risks are skewed to the upside, but having said that, are we going to end up with a very major bull market in the Sensex? No. Where are we going to be when we have this conversation in 6 months' time? The answer is probably 5 to 7% higher than where we are now. I think a final point is, what's going to happen on interest rates. And I think, there is a pretty broad consensus that the RBI is going to cut. And I think that given the inflation data and the need to reboot those growth numbers back to 7% plus, I think that that consensus view on the RBI is probably correct.
What about capital flows? Do you believe that India will get a higher share of capital flows if you look at it from an emerging markets perspective?
I think the interesting point is that investors worldwide started to increase risk positions post the Trump election. So we saw that in December and early January. But that increase in risk positions was mostly on developed equity markets, and a lot of it was actually driven by currency movements. So the weakness in the euro, the weakness in the Japanese yen obviously boosted the German and Japanese markets. What is, I think, interesting over the last sort of week or two is that we've seen risk generally reduced. We've seen that in the setback in the developed equity markets. But against that movement up and then sort of more risk off in developed equity markets, investors generally have been much more cautious on emerging markets. So that's for emerging markets as a whole. So my first point is I think emerging markets relative to developed markets are under-owned. Emerging markets as a block are cheap relative to developed markets. I think we should worry about the fact that the price-earnings ratio on the S&P is still above 17. So valuations are an issue there. If we look at emerging markets and capital flows, to come back to your question, my thesis is that as the Federal Reserve raises interest rates this year, you are not going to see the standard response of capital being pulled out of emerging markets. I don't think India or other emerging markets are sensitive to capital outflows. I do think you are going to see a steady, sustained movement in capital back into emerging markets. And India obviously stands out as the one bright spot in the global growth outlook. Now, that is obviously, I think investors need evidence that the growth outlook for India goes back to 7% plus. And if we stay at less than 7% growth, then I think the capital flows are going to be rather muted. But if we start to get, which I think we probably will in April and May, better economic data, I think that's going to act as the catalyst for foreign capital inflows.
Robert, let's talk about specific sectors. Was there anything in the budget that made you look favorably for specific sectors? Something that made you review your existing portfolio?
The answer is absolutely yes. And one sector globally which I like a lot, and which obviously has done well in India, has been the materials sector. That is linked into the boost in investment spending in infrastructure. Obviously, in the case of India, the boost in investment spending on infrastructure is going to be driven by the transport and energy sectors. But it's not just a question of investing in infrastructure, it's investing in construction companies who are building the infrastructure and also companies which are producing the materials for the construction of that infrastructure. So, the materials sector I continue to like. As a long-term trend and as a driver of Indian growth, I continue to like the consumer discretionary sector. That started well in 2017. The banking sector is being recapitalized. It's very necessary it's being recapitalized. If you're positive on consumer discretionary, then I think you have to be less negative, let's say, on the banking sector. I wouldn't say that my enthusiasm for the banking sector is elevated, but certainly I think one has to be less negative. I think, the other factor worldwide is I like the IT sector as a long-term strategic play. And I think India's position in the IT sector, remains impressive. So those are the sectors I focus on.
All right, one final question, Robert. Is there anything in the budget that you expected that didn't come through?
I think the focus in the budget, I would come back to my earlier point that there was a very realistic statement, which I think people are impressed by. The realistic statement was that demonetisation has been disruptive, and that has led to poor economic growth data in the fourth quarter, or towards the end of 2016. So that realism, I would have been very disappointed if we hadn't had that realism, and I think that's that's very positive in terms of recognizing that there has been a problem. I think one area which possibly one needs further work is further recapitalization and further addressing of the non-performing loans in the banking sector. And the latest data on non-performing loans, I think we all recognize that further write-offs are required, further capital is required, and it's interesting comparing the repair work on the American banking system with the European banking system over the last 5 to 8 years. The American banking system, action was taken quickly to repair the banks, and that is one of the strengths of the US economy now. The process, as we all know in Europe, has been far too slow. And I think India needs to take lessons from that difference between the success in America and the very lackluster performance in repairing the European banks. So I think more speed, more urgency is required there.